Welcome to Finstride, your one-stop shop for all things investing. In today's unpredictable economic environment, it's critical to talk about a topic that may make or break your financial future, the stock market crash. Are you ready for the unanticipated twists and turns that might wipe away your hard-earned investments? Join us as we explore the realm of stock market collapses, delving into their causes, repercussions, and most importantly, how to safeguard your money. Have you ever questioned if your portfolio is strong enough to withstand a market downturn? What techniques should you employ to protect your wealth when markets fall? This video will give you useful insights and effective advice to help you safeguard your financial future. So before you view the video, don't forget to subscribe to remain up to speed on our newest investing advice. Join us in this critical conversation and let's navigate the volatile stock market together. At Finstride, your financial well-being is our first focus. The adage, if you don't sell it, you have not lost it, implies that the value of investments is irrelevant until the day comes when you need to pay out. Market collapses, on the other hand, are unavoidable and can be disastrous. During a market crash, do nothing. Maintaining a consistent investing strategy that is supported by trust in your portfolio's assets is a fundamental concept of successful long-term financial planning. When you first built your investment portfolio, you most certainly factored in the likelihood of market downturns like the one we recently experienced. During stressful times, it is critical to resist the impulse to make rash judgments. Individuals who succumb to panic and sell off their investments hurriedly during a crisis typically come to regret their actions. A dramatic example can be found in the spring of 2020 when the S&P 500 fell by more than 30% in a relatively short period. Those who succumbed to fear and sold their shares will most certainly be sorry when the market recovers fast over the summer of 2020. By the end of the year, their losses had become even more evident as they had missed out on a significant 65% recovery from the market's low point. This demonstrates the significance of investing with discipline and a long-term view. During volatile market conditions, sticking to a well-thought-out strategy based on your financial goals and risk tolerance is frequently the best course of action. Only consider changing your strategy if you have a compelling reason to do so that is consistent with your overall financial objective. Shop. While the market is crashing, market collapses, such as those caused by unforeseen occurrences, such as the emergence of a pandemic or substantial policy moves, such as the Federal Reserve's monetary policy modifications, frequently send shockwaves throughout the financial globe. These chaotic times might aggravate the problem as leveraged speculators who borrowed money to invest in stocks face margin calls. This drives them to sell their shares in a panicked attempt to offset losses, resulting in a chain reaction of selling pressure. However, amid the upheaval and uncertainty, savvy investors can see a silver lining. Market meltdowns give rare chances, particularly for individuals who have been closely following the market. Stock and exchange traded fund (ETF) price declines might provide opportunities to acquire assets at significant discounts or to continue collecting shares of promising companies. According to Paul Miller, a CPA in New York, index funds are a good place for new investors to start. His recommendation is to invest in them regularly over time. This methodical technique enables investors to survive market disasters and potentially profit from a market rebound. Strategic investing in times of crisis can result in long-term profits. Even on the way down, the dollar cost average. Adopting a dollar cost averaging DCA strategy in a volatile market is a wise method for anyone wishing to indulge in a buying binge in the financial markets. DCA entails purchasing a fixed dollar amount of investments continuously, regardless of market conditions, including during periods of perceived volatility. This strategy works by smoothing out the ups and downs of your average cost of purchase over time, lowering it in the long run. By spacing out your investments in this manner, you reduce risk by not putting all of your money into the market at a single, potentially risky price point. This systematic approach can reduce concerns about a rapid market decline. It's worth mentioning that DCA occurs frequently when investing through employment retirement plans. However, if you manage your investments on your own, whether in a taxable investment account or a tax-advantaged individual retirement plan (IRA), your brokerage account typically allows you to automate your contributions, making the DTA strategy easier to implement and keeping you on track with your financial goals. This strategy provides not only financial stability but also peace of mind during volatile market moments. During a stock market crash, look for dividends. Down markets might be a good opportunity for the little more daring to contemplate letting dividends guide your investing decisions. Many corporations distribute their earnings to shareholders in the form of a modest dividend return each year, similar to how banks pay interest to savings account holders. While dividends aren't guaranteed and can fluctuate, Firms that pay them out tend to be more mature and their share prices are less volatile, and as long as the dividend is paid out, there will always be some benefits. This indicates that dividend investment might be a good decision during market downturns when share prices and returns are likely to decline. Make use of the sector rotation. Moving money from one sector to another, such as tech stocks during periods of rapid growth or utility stocks during periods of moderate development, is a common method for managing market downturns. Sector rotation, on the other hand, is not for everyone since it needs market timing. Desmond Henry, a certified financial advisor, recommends investing in diversified index funds to avoid this problem and maintain strong returns. These funds may perform well regardless of the direction of a sector, and if you hold the entire market, you're already set to gain from any sector's development, which may assist in propping up other sectors that may be struggling in the near term. Invest in bonds amid a market downturn. Down markets provide an opportunity for investors to investigate an area that beginner investors may overlook: bond investment. Government bonds are often regarded as the safest investment, despite their unappealing appearance and typically low profits when compared to equities and even other bonds. Nonetheless, given their track record of perfect repayment, holding certain government bonds might help you sleep better at night during times of uncertainty. Government bonds must often be acquired through a broker, which may be costly and confusing for many private investors. Many retirement and investment accounts, on the other hand, include bond funds that include a variety of government bond denominations. However, don't assume that all bond funds are filled with secure government bonds. Some include riskier corporate bonds. Reduce your losses during a crash. Tax loss harvesting is an investment technique in which you may balance income with realized losses, possibly decreasing your tax burden. If you invest in a taxable account, you can invest differently and recover losses on your taxes. However, to prevent a wash sale, it is critical to check with a tax specialist before applying this technique. You may also use a robo-advisor, which already has tax loss harvesting tools. If you are about to retire, proceed with caution. A stock market meltdown may be a major source of stress for retirees. To prevent the worst consequences of a downturn, it's critical to properly plan your retirement, changing to conservative, bond-based holdings and using a bucket technique to keep a portion of your nest egg invested. This enables you to capitalize on future market recovery and expansion. To be prepared for market shifts, persons approaching retirement should begin planning asset allocation modifications as they mature. Discuss your choices with a financial counselor. A stock market meltdown can be a frightening experience, but keep in mind that it is simply a temporary setback. Following these suggestions can help you secure your investment and emerge stronger on the other side. Thank you for taking the time to read about how to protect your savings during a stock market crisis. We hope you found these tips useful. Don't forget to like, comment, share, and subscribe to receive more financial advice.